Welcome once again to our Farm Management and Finance educational series. Borrowing money is something that is a necessary aspect of running a farm or ranch business for most of us, at least at some point in the business life. In this video segment, let's explore some of the basic details of borrowing money for business purposes. So here's what we hope to cover, or at least provide an overview of. The most common types of loans used by agricultural operations, interest rates, and more importantly, the impact of interest rate on the loan and the loan payments. We've been quite blessed, perhaps spoiled is a more appropriate term, for a very long time period by historically low overall interest rates. Those of us who have to borrow money for our businesses, of course, hope that continues. However, history suggests that this may not always be the case. I also want to cover a few details regarding the impact of some other quote-unquote terms of loan contracts and a related topic, how various levels of down payment might impact the loan overall. Let's begin with short-term loans. Agricultural producers often need short-term loans, which are also commonly referred to as operating loans. For simplicity, we will consider any loan for the purpose of under 1 year to be a short-term loan. Examples include loans to purchase stocker or feeder cattle, or loans for inputs to put out a specific crop. The main point is that proceeds from the activity that the loan is taken out for are expected to fully pay back the loan. For example, if you take out a loan to purchase stocker cattle, then when you sell those cattle a few months later, there is expected to be enough money to pay the loan back. Or if you borrow money to buy seed and fertilizer to put out a crop, then when the crop is harvested, there should be enough money to pay back the loan. Therefore, operating loans are what we often refer to as self-liquidating loans. Traditional operating loans were often single-purpose loans with a separate loan document for each purpose, meaning that you would take out a loan for a very specific purpose, like buying a particular pen of stocker cattle, and then you would pay that loan off when those stocker cattle were sold. If in the meantime you needed money for another pen of stocker cattle before the other one was sold, or if you also need money to plant your soybean crop, you take out a separate loan and pay that loan off when that activity is completed. Those types of loans still exist in some instances. However, it's becoming more common for operating loans to be set up on what's known as a line of credit, where all borrowing needs are projected for a time period, for example, a year, and the loan is a line of credit where funds are drawn out as needed, say for example to buy stocker cattle or crop inputs. Then the line of credit is paid back as funds become available from the sale of cattle or crops or whatever. The line of credit might not ever get paid down to zero, because at the end of the year there might still be a pen of stocker cattle that have not been sold, or there might be crops that are growing but have not been harvested and sold yet. The borrower needs to maintain communication and visit with the lender to renew the operating line on a periodic basis, usually annually, and to make sure that the funds are being drawn and paid back appropriately. Warning flags are triggered for both the producer and the lender when the carryover operating line of credit balance begins to increase from 1 year to the next, and there's not a good explanation for that, such as the farm growing in size. Longer term, we'll call them multi-year loans, are typically what are known as amortized loans. This means that the principal is paid off a little bit at a time over the period of the loan. Typically, we think of these types of loans being used to purchase assets that are expected to last more than a year, such as breeding livestock, equipment, land, or buildings. In many instances, it is common to set up the loan to somewhat match up with the expected life of the asset that is being purchased, though we would of course like for the loan to be paid off before the asset completely wears out or becomes worthless. The exception to that, at least here in the United States, is land. Of course, we don't ever expect land to wear out. In fact, we usually expect it to increase in value over time. We don't, however, see land loans in the United States that go on forever. With that said, in some other countries, it's not unheard of to see real estate loans that are extremely long-term in nature, like 100 years, for example. In the United States, they're more typically 25, 30, or 35 years, perhaps a little longer, a little shorter. With amortized loans, the accrued interest is typically paid with each payment cycle, annually, monthly, etc. In addition, a portion of the principal is paid with each subsequent payment. Perhaps the least common, but certainly not completely uncommon, type of amortized loan is the level principal payment loan. Under this type of loan, an equal amount of the principal is paid with each payment along with the interest that has accrued since the last payment. So, for example, for a 5-year, $10,000 level principal payment loan, the borrower would repay $2,000 of principal with each payment, or $10,000 divided by 5. In addition to that, they would pay whatever interest had accrued over the payment period. Therefore, with this type of a payment plan, while the principal portion of the payment stays the same over time, the interest portion of the periodic payment will decrease as the loan gets paid down because interest is accruing on a smaller remaining principal amount for each subsequent year or time period. This example amortization table shows the no-till drill purchase example from the example case farm that was set up on a 7-year level principal payment loan at 2.25% annual interest. Notice from the table that the principal portion of the payment remains the same for each payment, but the interest portion of the payment goes down or declines over time, resulting in the total payment declining somewhat each year. This type of payment plan might be attractive in a situation where the borrower thinks they will be better able to make a little bit larger payments early in the life of the loan. For example, they think commodity prices will decline a bit later on, resulting in less money available to make payments a few years down the road. The most common type of amortized loan is the level payment loan. These are loans where the total payment remains constant over the life of the loan. Since each payment includes all accrued interest up to that payment time, the early payments, when the principal balance is still large, will include more interest, and as the principal balance gets paid down, the later payments will include less interest and more principal. Most people are very familiar with level payment amortized loans. Most car loans, home loans, etc. are this type of a loan. This amortization table shows the $56,500 no-till drill loan set up on a 7-year level total payment plan at the 2.25% interest rate. Notice that the total payment remains the same over the life of the loan. But unlike in the level principal payment plan example, here the principal portion of the total payment increases over time while the interest portion declines. Early in the life of the loan, the total payment is higher using the level principal payment plan than it is for the level total payment plan. However, the opposite is true late in the life of the loan. Interest and interest rates are an important topic when talking about loans in general. So why do we have interest rates anyway, and why do they change over time? Interest rates represent the value of money over time. You've probably heard the old saying, a dollar today is worth more than a dollar at any time in the future. That statement is true because of interest. Money has value over time for 3 reasons. There is the pure time value of money, which is a function of the fact that people just like to have stuff now rather than later. So if I'm going to loan you money today, that means I don't have that money myself to go buy stuff with. So I have to make that trade-off, do something else with my money instead of buying something that I might want with it. Suppliers of money demand to be compensated for that foregone consumption. There's also an expectation that the things I need to buy will cost more money at some later date in the future than they do today, simply because the price of stuff goes up over time. We of course call that inflation. If I'm going to loan you money instead of buying things that I want with it, I will demand that I at least be made whole or compensated enough at a later date that I can at least buy the same stuff that I could have bought earlier and consumed if I had not loaned you the money. Finally, if I'm going to loan you money, I probably want a little cushion in there to account for the fact that there's a chance you might not pay me back. There are other risks as well, but one of the big ones is what I just mentioned. We call that default risk, the chance that the borrower will not pay back any or all of the amount of money that was originally borrowed. Interest rates change over time. For example, at the time of this recording, interest rates, while still very low from an historical perspective, have increased somewhat from the levels of, say, a year ago. Interest rates in the 1980s were much higher than they are today, and so on. These interest rate changes over time are primarily caused by changes in inflation and inflation expectations over time. As the overall economy heats up, inflation fears and expectations increase, and typically interest rates increase as well. Conversely, during times of economic slowdown, inflation fears decrease and interest rates tend to decrease as well. The Federal Reserve Board often tries to counter these demand influences on interest rates by trying to influence the overall supply of money to keep interest rates from moving too far in one direction or the other too fast. Another observation about interest rates is that many different interest rates can be observed at any one point in time. As a matter of fact, a particular lender might quote different interest rate offers to two different customers on the same day for similar types of loans. This is a direct result of different perceived risks. Loans that are perceived to be more risky for the lender will only be made if the reward, i.e. the interest rate, is high enough to compensate for the higher degree of perceived risk. This is of course why most credit card debt is associated with a higher interest rate than many other types of loans. On average, the percentage of total credit card debt that does not get paid back is simply higher than it is for some other common types of loans. As an example of the impact of interest rate on loan payments, we showed previously that using the level total payment amortization table of the loan on the $56,500 drill purchase at 2.25% interest rate, financed over 7 years or 7 payments, the annual payment was right at $8,814 a year. If the only financing that the borrower could obtain were at 5.5% interest instead of 2.25% interest with all other terms the same, the annual payment increases to about $9,942 per year. Interest expenses were one factor that made the farm financial crisis of the 1980s such a financially challenging time for many producers. Another factor that definitely impacts the quote-unquote feasibility of an amortized loan is repayment terms. Going back to the $56,500 drill purchase example at 2.25% annual interest, the payment based on a 7-year loan is $8,814 a year, as just discussed in the previous slide. Some lenders are reluctant to finance equipment over that long of a time period. If the borrower could only get a 5-year loan, for example, the all else equal payment would increase to $12,074 per year. You can easily see that in tight margin years, this makes the payment much more difficult to make. On the other hand, if the borrower could feasibly handle the larger payments, the shortened repayment term results in significantly less total interest being paid over the life of the loan. For all amortized loans, including longer-term real estate loans, finding that appropriate balance between a long enough repayment term to keep the total payment low enough that the producer can feasibly handle those payments even during lean times, and keeping it short enough that the borrower keeps total interest expense as low as possible and builds equity as quickly as they can, is a real financial challenge. To demonstrate a common example of a longer-term real estate loan, for example, a $250,000 land loan financed over 20 years at 5.5% annual interest, the annual payment would be about $20,919, just a little more than that. Over the life of the loan, you would make a total of about $418,400 in payments, with about $168,400 of that being interest. If a person could increase the down payment, could come up with another $50,000 to reduce the initial loan amount, that reduces the annual payment substantially. For example, if the loan is only a $200,000 loan at that same 5.5% interest for 20 years, the annual payment is reduced to $16,735 or close to $736, and over the life of the loan, the total payments made would be about $334,717, with only about $134,717 in interest. So, being able to come up with a larger down payment to reduce the amount financed reduces the annual payment substantially and reduces the amount of interest paid over the life of the loan by a considerable amount. Interest is a very real expense, and over time it can really add up. Make sure that the assets that you're purchasing are earning a total return that will at least keep up with the interest expenses over time. The final type of amortized loan that I want to mention in this video is the partially amortized loan. This is a loan where only part of the principal is paid off over the amortization period. Then something has to be done with the remaining quote-unquote balloon debt at the end of the loan contract. You may have heard of loans with a balloon remaining at the end. That's what they're talking about. An example would be the $250,000 20-year land loan, 5.5% annual interest, but with a $100,000 balloon, so we're only going to be paying off $150,000 of the loan over the 20-year time period. The payment on that loan would be about $18,051 or $52 instead of the $20,000, almost $21,000 if we financed the entire or if we paid off the entire $250,000 over the loan period. But remember, at the end of the 20 years, the borrower, if they took this out to the end of the loan contract, would still owe $100,000. So under what circumstances would somebody want to take out a loan like this? These types of loans are actually quite common. In many situations, these types of loans are used when the borrower never really intends to keep the underlying property until the end of the loan contract. For example, a person may buy a house, but they only really intend to live there for 10 years. They use a 20-year loan with a balloon, for example, to keep the payments a bit lower while they are there and at the same time build a little bit of equity in the real estate. Then they sell the house and pay off the remaining debt, including the balloon, before the end of the loan contract or even at the end of the loan contract. So, it's a balance between keeping the payment a bit lower or building equity faster. It's used only to finance assets that tend to go up in value, or at least tend not to go down in value. So the lender is assured that there will be plenty of collateral at the end of the loan contract. So in summary, I'd like to thank you for your attention to this segment on the details of lending. What we discussed and confirmed is that how money is borrowed can significantly impact the financial health of the business, and length of payment term, interest rates, whether or not there's a balloon payment involved, can have both cash flow and profitability implications. Thank you for your attention to this video segment.